Today, we will talk about what's in every investor's mind. Is the current bear market over yet? Are we there yet? Well, short answer. Probably not. What's up, guys? It's Douglas here with Investing Unlocked. So what do we know? The S&P 500 is trading at approximately 20% below its all-time high. The Nasdaq came down near 28%. And the Dow Jones Industrials is trading 15% lower. Wait a minute. If all major indices are trading in major correction territory, why am I not too bullish just yet? Well, because I believe we are still too early in the process to take extra valuation out of stock prices. Peter Lynch once said, "You get recessions. You have stock market declines. If you don't understand that's going to happen, then you're not ready, you won't do well in the markets." Remember folks, this video is for educational purposes only. And it should not be taken as financial advice. Let's get unlocking. One way to look into stock valuations is to study the Shiller price to earnings ratio, also known as the acronym CAPE ratio, which stands for cyclically adjusted price to earnings ratio. We know that a company's PE ratio helps investors decide whether a company is undervalued or overvalued by comparing its stock price to its earnings per share. The issue is that the traditional PE ratio might be unreasonably impacted by short-term fluctuations in a company's earnings performance due to reasons that are more related to market-moving economic events than to its fundamentals. Nobel Prize winner and Yale professor Robert Shiller suggests examining the 10-year earnings data that has been adjusted for inflation to minimize the impact of short-term effects. In other words, the Shiller PE ratio is a valuation metric that shows the multiple that the current price is trading over its 10-year average earnings, adjusted to inflation. Low PE ratios suggest a company might be a good buy, with the potential for high future profits, while high PE ratios typically signify that a company is overpriced. This analytical tool is commonly used to evaluate the overall US stock market. Let's hear Nobel Prize winner Robert Shiller talking about the state of the exuberance of the market at the end of 2021.
Incredible. You wonder, what are people thinking? Well, part of what they're thinking is that this is going to last, that there's a commitment from our central banks to do things like quantitative easing. Let me just talk first of all about the surprising levels of exuberance in markets today, which is I'm going to talk about, there are excesses in all three basic major asset classes: stocks, bonds, and real estate. I'll talk about those, and then talk about inflation in consumer prices, which is an emerging narrative. So I'm going to talk about those three asset classes. This is a plot using the blue line is not mine, it's the Standard & Poor's Composite Stock Price Index, which since the 1950s is called the Standard S&P 500. In real terms, I've taken the inflation out of it. And I don't know if it strikes you, but this behavior of the index looks awfully strange right now. The green line is earnings per share that corresponds to this, partly backdated by Alfred Coles to 1871. And you can see that it's been choppy. It's not clear that we're not on an earlier trend. Why are the prices so high now?
As you heard, Professor Shiller had some major concerns about the increased valuation of all asset classes up until the end of 2021. Historically, the median Shiller PE ratio for the S&P 500 is 15.87. The current Shiller PE ratio, as of July 10, 2022, is almost 90% higher than the median average, at 30.04. Even after the sharp stock prices drop that occurred during the last 6 months or so. That means, the average PE ratio for the S&P 500 would have to fall considerably more to reach closer to the historical averages. However, we also know investors should not use any single measure of market valuations to determine market conditions. If you are a beginner, or you just need to review some important financial ratios, I recommend you to look into our series Invest Like a Pro. If you are enjoying our content, please press the like button. It will help the YouTube algorithm recommend our content to others as well. And consider subscribing to our channel. It will mean the world to us. Okay. Let's look into another market valuation indicator. Let's see what the BOFET indicator is telling us. The BOFET indicator is the ratio of the total United States stock market valuation to the U.S. gross domestic product. That indicator is an important tool that investors can use to have a bird's eye view of the total market valuation. To calculate the BOFET indicator ratio, we divide the total U.S. total stock market value by the U.S. GDP. The Wilshire 5000 index is the most common measurement of the aggregate value of the U.S. stock market, as it seeks to capture 100% of the U.S. investable market. As of July 8, 2022, the total aggregate U.S. market value is around $38.8 trillion. And the annualized GDP is $24.3 trillion. When we divide $38.8 trillion by $24.3 trillion, we get a ratio of 1.59. Or 159%. As of July 8, the BOFET indicator is currently about 33% above the historical average. Therefore, this second indicator also suggests we are still too early in the process to force excess valuation out of stock prices. And here is why I think investors should avoid getting too enthusiastic at this time. I am not a pessimist. But I believe this situation can get much worse before it gets better. And here is why. The historically low interest rates that we had since 2008 was the tool the Federal Reserve used to help the economy after the financial crisis of 2008, and to fuel the greatest and longest bull markets ever. This is because borrowing money to grow a business is very appealing in an environment with near zero interest rates. Who doesn't love cheap money? But what happens when the Federal Reserve raises interest rates instead to curb inflation? Well, it shouldn't be a surprise to anyone that the opposite happens. As money becomes more expensive, borrowing becomes less attractive. Therefore, businesses and consumers start to spend less, and demand is cut back, lowering economic activity and hopefully cutting inflation. Don't forget, this is precisely the reason why the central bank is raising interest rates in the first place. And, the more the Fed increases the interest rates, the more likely we are to go through a recession. And so far, at this stage, what we watched was share prices dropping. We haven't seen earnings outlooks being trimmed yet. If the earnings outlook starts to drop as a result of the current tightening monetary policy, then we will see valuations go back up. Why? Because in the price to earnings ratio, when earnings decrease, the PE increases. Therefore, I believe it's very possible that the increased valuation will have to be corrected before the bear market is over. The current S&P 500 PE ratio is 19.33. That is, without earnings drops. The historical PE ratio median is 14.89. So, you see, even in the absence of any future lowering of profit projections, stocks are still a little too high to declare a bottom. In addition, before the next bull market cycle begins, equities often decline below historical valuations before rising again. Therefore, if earnings expectations are cut by, let's say, 10 to 20%, that means we still have quite a good way to go. Because value investors will want to see lower price to earnings ratios before they start bottom fishing. And, therefore bringing more liquidity to the market to start the next bull run. So, how long did bear markets last and how low can we go? Since 1950, the S&P 500 has dropped more, or near 20%, on 16 occasions. On average, bear markets last 11 months. The average drop is 29.8%. And, the median is 24.6%. No. It doesn't mean this one will magically last exactly 11 months. But, we are about 6 months in already. And, looking back at the historical data can help you plan your next move. Let me be clear. I am not saying you should sell all your stocks and run for the exits. I am also not saying you should wait until the end to start buying. Because I am not. I am already buying some good quality companies that are trading at a larger discount. Because if you are in the market as long as I am, you know that it's really difficult to call the bottom. But, it's crucial you understand that stock valuations are still high. And, you shouldn't be too optimistic yet. I think it's very possible that the S&P 500 can decline at least 10 to 20% more before excessive valuation normalizes. But, exactly how much lower? It will depend on the next two coming earnings season and the company's guidance, as well as the effect of the increased interest rates on the US inflation levels. As of now, US workers are still benefiting from a strong job market. As companies fought to retain their current personnel, layoffs reached a historic low in April. It will be interesting to see what the end of the Federal Reserve's quantitative easing will mean to the job and equity markets going forward. But remember, even though we can't precisely predict how steep the decline will be, or when that drop will stop, if you are a long-term investor, it's always been a good idea to buy the dips in the S&P 500. Because eventually, investors are beautifully rewarded. But, remember to be cautious and selective. And, look for quality companies that are trading at a good discount, have a good cash flow, and are not highly leveraged. Thanks for watching. Good investing, and I will see you next week.